The Federal Reserve made its long-awaited decision on interest rates this week. The Fed decided to lower the federal funds rate by a quarter point. That was widely expected. But many people sitting on the sidelines when it comes to buying or refinancing a home took note of mortgage rates. The 30-year fixed mortgage rate dropped to 6.26%. That's the fourth consecutive weekly drop. It's also the lowest rate in nearly a year. And still yet, there are growing concerns about tariffs and other Trump policies and their impact on prices of everyday essentials. Let's discuss this all with nationally syndicated personal finance columnist Terry Savage. She's also the author of The Savage Truth on Money. Good morning, Terry. Thank you so much for being here with us. I have so many questions for you, but let's start here.
Okay.
The Fed did the thing everyone's been waiting for and talking about for months now. Interest rates were lowered. What does this mean for the regular consumer?
Well, it depends on which side of the aisle you're on. Are you a borrower or a lender? The Fed, we hear so much about the power of the Fed, but basically they set short-term interest rates. Short-term interest rates like overnight rates that banks lend to each other. They actually have less influence on longer-term rates. You know, the United States has borrowed trillions, like about $38 trillion. That's our national debt. And we finance it by selling short-term IOUs and longer terms, treasury notes and bonds. And the rates on those are set in the bond market. And rates on short-term notes, interest rates will drop. Savers are going to see their CD rate yields drop when they come to renew. Treasury bills are a little bit lower, under 4% now. But funny thing happened on the way. A year ago, when the Fed cut rates, short-term rates, by a full percentage point, mortgage rates went up by 1%. And just this week, although short-term rates have dropped a bit, longer-term rates inched up in the last 2 days. That's what sets mortgage rates. So mortgage rates dropped in anticipation. We're down about 6.25% on a 30-year mortgage. They may not drop much further if the rest of the world says, wait, there could be inflation in the United States. We don't want to lend at low rates. We're worried about that.
All right. Well, Terry, listen, I'm one of those millennials who has been salivating for a while, trying to buy a home. But, you know, I feel like I and many others have been told, wait, mortgage rates are high, et cetera. What's your take right now? Is it more feasible at the least, or even the right move today to try and buy a home?
Oh, sure, it absolutely is. If you're secure in your job, and that's the other thing weighing on the mortgage market. There's a lack of supply, and all those people that got their mortgages at 3% a few years back don't want to sell because if they move, they'll have to pay over 6% for a new mortgage. That gap is narrowing now. But this historically, 6.25% is not high. There was a time when mortgage rates were 13 and 14% back in the early 80s, and people still bought homes and waited for rates to drop and refinance. So if you're comfortable and secure in your job, which is something many people aren't these days, then you should go out and grab the 6.25. Worst comes to worst, rates drop, you just refinance.
All right, that's good news. I like that, Terry. Appreciate that. Tell me, though, does this economic news of the week mean that prices may start going down as well for, say, everyday things like at the grocery store?
Do not hold your breath. First of all, a lot of the...
You had me happy for a minute there, Terry.
I know. I'm sorry about that. But think of all the things we import. In fact, I just went to buy coffee, and I buy those K-cups, I'm not embarrassed to admit. And I usually look for them at discount stores where they're like 51 cents a cup. I mean, at Walmart, it was $1.40 something, the unit price. Stuff we import went up and is staying up because the tariffs continue to exist. So whether prices continue to rise depends on the items we're importing. In the winter, we'll see more of it because we import fruits and vegetables from Mexico and so forth. But I don't think you're going to see prices drop, not for a long time. And it would probably only happen if we had a terrible recession and people stop buying pricier things. So while you can hope for prices to level off, that's what the Fed's hoping for, they're still rising around 3% a year from very high levels. That's all cumulative. People who are on fixed incomes are finding it very tough at the grocery store still.
Terry, what about consumer goods? And we're focused on the grocery store for a moment there, but what about things, clothing, furniture? Is there a sector that you're looking at where prices may fall?
I don't think prices are falling. The question is, will they level off? And a matter of fact, even the Fed chairman said, we don't know with all the tariffs that have been paid, $1 trillion collected by the government already, if that's already been passed on to consumers.
Right.
Right now, it looks like the consumer's strong and still spending. But wait, where are they spending? Credit card debt is at an all time high. And that doesn't even account for all these buy now, pay later. That's not included in credit card debt. 4 easy payments. Well, I'll do it once. Well, no, I'll do it for this. And pretty soon those payments start overlapping. So consumers are carrying a record amount of debt. They're 2/3 of the economy. We're coming up on the holiday season. Higher prices exist, may go higher as more tariffs get passed through. It's going to be a very tricky season for retailers figuring out how much they can raise prices and for consumers how much more they can charge.
Oof. All right. Well, a lot to look forward to, and still a very developing story. Terry Savage, appreciate your time this morning. Thanks.
Thank you, Dan.